In this episode of the Seatrade Maritime Podcast, we'll be talking to Will Fray from Maritime Strategies International about the outlook for the dry bulk shipping market in the second half of 2025. Will, welcome back to the podcast.
Thank you very much, Marcus. Nice to speak to you again.
Likewise, and thanks for taking the time. Could you start with an overview of the dry bulk shipping market over the last 6 months of the year?
Yeah, the market certainly started on a weak footing start of this year. So as we approached the end of last year, end of 2024, rates started to soften, and in January, February, things were not looking very rosy at all. But then there was a recovery through Q2, and indeed we saw Capesize spot rates spiking up to $30,000 a day, which perhaps was a little bit unexpected, the strength of that market. But overall, I think the point is that on a year-on-year basis, average earnings in dry bulk for the first half this year have been down around 25% year-on-year. And that applies to rates as they are at the moment as well. Now that the Capesize sort of spike is over and rates have dropped back to $15,000 a day, then across all benchmarks, they're down by about that amount year-on-year. I think if anything, that underlying fundamentals have weakened since we last spoke. That's both from a trade perspective and a supply perspective. So this sort of recovery we've seen recently, I think we're now wondering how long this recovery will be sustained. Now, the recent spike in Capesize markets is quite revealing, really. It tells us that despite this weaker trade volumes and a consistent throughput of new ships being delivered, then market balances are still robust enough to support these short-lived upticks. And I think that's something we can expect to continue for now, driven by short-lived trade factors. This Capesize spike was driven a lot by increased chartering activity in the Atlantic for bauxite trade as well as iron ore. And we've seen Panamax earnings start to improve a lot due to the late Brazilian soybean season, and also supported by the persistent inefficiencies in the market, such as access to the Suez Canal. Thinking of other kind of demand factors, then last time we spoke, we were talking through the impact of Chinese stockpiling of raw materials through 23, 24 in particular, and how that supported the markets. And actually, iron ore stocks have started to decline a bit in China. So maybe we'll see a kind of short-lived uptick again where China is rebuilding those stocks. So there's potential right now for some kind of short-lived spikes to live on for the near term. But I think as we head into 2026, then we see market balances weakening, and these kind of short-lived spikes will be temporary and on a downwards trend.
You say you see those short-lived spikes continuing sort of in the second half of this year. Would it be fair to say that overall, though, you expect the market to be at a lower level than it had been?
Yes, absolutely, yes. I mean, clearly rates dropped at the end of last year. It's something that that at least looking at the fundamentals of trade and ships being delivered, then that feels like a trend that might be repeated again this year, albeit by nature of these kind of short-lived spikes, you can never tell the timings of when they might happen. So, but the potential is still there, but that potential will start to decline as we go into 2026. So year on year, yes, we're expecting earnings to be weaker for dry bulk than last year.
Okay. You did mention Chinese iron ore demand there. Is China still remaining that main engine of dry bulk?
Well, this is the sort of bit of a quandary, really, and the demand data from China is so very weak. And that's right through from a consumption perspective through to a trade perspective. So steel output's down by 1% year on year. Iron ore trade is down by about 3% year on year. And some of that is because of destocking of iron ore. Coal trade's down 5%, and coal trade is a real concern. So again, to refer back to what we talked about 6 months ago, the building of Chinese coal stockpiles has been a huge factor supporting the market. And we talked about a kind of natural limit, or a policy limit, let's say, where Chinese government wanted to build stockpiles equivalent to 15% of consumption, and that was essentially being reached. And And in this year, those coal stockpiles haven't really moved in any particular trend from where they got to. So now Chinese coal demand is soft. Production's been supported. They're not building stockpiles anymore. And then coal trade's down by 5%. Incidentally, in coal trade, is also a little concerning to see Indian imports declining as well, mainly because domestic production, coal India, has been very positive recently, much better than maybe 5-10 years ago, where coal India struggled to meet targets. Domestic production of coal in India has been very strong. That's dented India's import demand. So the coal trades certainly suffered not only from weak Chinese demand, but weak demand elsewhere. Yeah, we're sticking with China then on grains as well. Chinese grains imports are very soft. There was quite a good period for production in China in that sort of wheat and coarse grains group where imports this year are down by more than 50%. And meanwhile, soybeans are down by about 4%, although that's partly due to this late Brazilian export season, so that will pick up. But in each of those commodities, it's all quite negative. And it's very difficult to pick out a particular driver that will support that going forward beyond this kind of near-term soybean trade into China from Brazil and maybe some of that iron ore restocking, and also bauxite markets, of course, have been quite positive. And we're expecting bauxite trade to grow by 7%. But those are all kind of offsetting factors behind the weaker trends in the larger commodity groups.
That's not a particularly positive picture on the demand side, is it? We were talking before about with the other sectors, the various sort of geopolitical factors, tariffs, the situation in the Middle East, and so forth. How does that play into the dry bulk market?
Yeah, well, I think from a tariff perspective, the main concern for dry bulk remains that soybean trade from the US to China, depending on what China decides to do in retaliation to US tariffs. And as Dan mentioned in your discussion about containers, we're still kind of waiting for that tariff position to be sorted. And with the US soybeans exports are ramping up later in the year, then there's still time for that to be resolved or partially resolved. We're expecting some impact. So we are expecting, number one, demand for Brazilian soybeans right now to be very strong. And the Brazilian harvest is a good harvest this year. So we're expecting strong Brazilian soybean trade in the short term. And we think there's going to be some impact on US shipments of soybeans later in the year to the downside. And it won't be as bad as back in 2018 when China's swine herd had a case of African swine fever had meant a lot of culling of their swine herd, and their demand for soybeans was lower. So that was part of the reason why soybeans trade declined so much that time around. We don't expect the same to happen this year, but still it's slightly negative. I think there's actually potentially some minor support to be had from US tariffs, in that if they're going to reduce trade from Canada, Mexico, then perhaps you might see some of those exports finding their way on longer haul routes elsewhere. So you could argue maybe some short-term positives for geared segments. But because the US only imports around less than 2% of world trade, it's not really going to be a huge driver. It's more their exports that are the big concern. And of those, it's China's soybean trade that's the major risk to the downside risk to the market. Beyond tariffs, we've covered the situation in the Middle East, and that's and dry bulk markets are not isolated from that. Although, if there was bigger escalation issues in the Straits of Hormuz, then dry bulk is perhaps a sector that won't be impacted to a similar degree as what you'll see in tankers, for instance. So perhaps it's sort of isolated for some of the worst issues in that region. But it's unpredictable, and they're causing inefficiencies, and you never really tell how much disruption can really support freight markets. And so overall, I think we can say that the markets right now would be a lot weaker than they would have been without these kind of disruptions, which will looking like they will continue for now.
Okay. That's kind of worrying what the markets would look like without those disruptions. Just looking at the supply side, correct me if I'm wrong, but the order book is relatively low for dry bulk and shipping it. Does that mean that as we sort of go further out, that there could be a shortage of tonnage in a few years' time, or how does this all look?
It's a really, really good question, a very interesting question, because it's quite accepted in the market that an order book of around 10% seems to be very low. You said relatively low. And you're right in that it's relatively low historically. But is it relatively low given future expectations for trade? And that we think is a question that's worth digging into, because in a world where trade and demand is flat, then an order book of around about 10% or even anything above 10% starts to appear like a bit of a threat to the market. Not undersupply, but oversupply. And the issue we have is that with China's import requirements being weaker, and if you look longer term, then I think coal trade in particular is expected to decline. And MSI, in our outlook, we're also expecting iron ore trade to decline long term, offset by some stronger trade, grains, for instance, and other minor bulks. But overall, that historically strong year-on-year trade growth in dry bulk, which is supported by China's industrialization, is now shifting and changing, and we should not expect that similar rate of growth in future, in which case we should not see a order book of 10% to be kind of a low order book relatively to that forecasted demand. And really, if you look at ships being delivered this year, next year, I think previously we discussed about understanding the impact of these about 35 million deadweight new ships being delivered this year. And I mentioned previously a incremental demand of 240 million tons of cargo required to absorb that tonnage. And given the weaker trade outlook, actually we're projecting incremental trade of only 50 million tons of trade this year. And 2026 is not looking a lot better. And so you have then cumulative effects of 35 million deadweight delivered this year and something slightly higher delivered next year. And in that context, then this is certainly going to be a market that, with that outlook, would be oversupplied. So MSI is becoming more pessimistic on the market balances for bulkers next year. I think kind of longer term, then again, does this order book look low in that context of flat trade growth long term? And probably not. I think we would expect ordering to be more linked to the energy transition in shipping and in ordering dual fuel ships. And now we have the IMO midterm measures and putting some numbers on the rewards for or at least the lack of penalties for using dual fuel vessels. Then we can start to plan a bit more, and we can see that maybe in the future there might be a slightly different dynamic to the order book, in that periods of scrapping of older ships is then offset by periods of contracting for new fuel efficient dual fuel vessels. And we may find in future a kind of a larger amount of contracting, a larger amount of scrapping than we had in the past, as those sort of differentials in fuel and carbon costs widen for dual fuel on modern ships versus old ships.
That's a very interesting answer to that question, actually. I think it kind of gives a lot of colour to the complexities that are involved in what's going forward. Thank you, Will.